Assalamualaikum warahmatullahi wabarakatuh. The last step in the credit risk management process is the credit risk mitigation. Earlier we have reviewed the first two steps, which is credit risk identification, followed by the credit risk measurement, and now the last one would be involving the way and means by which the bank would try to minimize the credit loss within the risk appetite acceptable to the bank. So risk mitigation is a means by which the bank would look for ways and means to minimize the loss from the loan and murabaha exposure. And the main three risk mitigation tools are as follows. We have number one, collateral, number two, guarantee, and number three will be the credit default swaps. And again, I will be using the term loan and murabaha interchangeably because we are dealing with the financing arrangement involving the buy and sell of murabaha. So we are looking at the second stage of murabaha, where the bank sells the asset to the customer based on deferred payment, and this is equivalent to the loan financing, where the borrower will have an obligation to pay off what they owe the bank, consisting of the loan plus interest. So in order to ensure that the loan and murabaha is in good hands, in the sense that the bank would want to minimize the possibility of default and the ability to recover their loan or their murabaha in case there is a default, then these risk mitigation tools are very, very important in banking. Number one is the collateral. Collateral is an asset that the borrower pledges to secure the loan or the murabaha. So if the borrower default, the lender or the bank can seize the collateral to recover part or all of the loan amount. So we are dealing with a loan or murabaha whereby the bank, will be giving away this liquidity to the customer, and the customer will use this money to purchase the goods or to purchase the asset, and this asset will then be used as a collateral against the loan taken by the customer. So suppose the borrower or the customer takes out a loan or murabaha of 1 million from the bank to fund business expansion, and the borrower pledges real estate worth 1.2 million as a collateral. So this is but an example involving a liquidity financing, where the borrower needs that cash proceed to basically renovate or to expand his factory. And what he will do here is to place an asset which is separate from the business asset as a collateral. So the LTV ratio, as what we have discussed earlier, would be 1 million, which is the amount of the loan or murabaha facility, divided by the collateral of 1.2 million. So the LTV is 83%, and that is good enough because the benchmark is about 75%. Anything higher than 75% is much welcome by the bank. Right? We can also see that this loan or murabaha can be used to purchase property or to purchase automobiles, For automobiles, we will be referring to ITAP financing. For conventional loan, it will be like hire purchase. And we will see that the asset that was utilized to purchase the car or to purchase the house will be used as collateral. So there's a charge against the collateral, meaning that the collateral belongs to the bank in case under a default event. So we look at here, so in any sale and purchase agreement, or we have a sale and purchase agreement in property financing. So we got the loan agreement and we got the charge agreement. So the charge agreement will imply that the house will be charged as a collateral against the loan or against the murabaha. So in the case of this example, $1 million of loan or murabaha divided by the collateral, which is the property, 1.2 million, and the loan to value ratio or the financing to value ratio will be 83%. And what it implies is that if the borrower default, then the bank can sell the property worth 1.2 million to recover the loan facility or the murabaha facility of 1 million. So the excess value of the collateral can either be returned to the borrower or used to cover additional costs. But what it implies here is that upon default, the bank should be able to recover whatever that they have extended to the borrowing customer. So the benefit of collateral is that in case of default, the bank has a tangible asset to recover the loan. The asset can be a car in case of hire purchase, or the asset can be a home property, apartment or landed property, thus reducing the risk of loss. Number 2 will be the guarantee. The guarantee involves a third party who is a guarantor committing to repay the loan or murabaha if the borrower defaults. So this provides an extra layer of security to the bank, because if the borrower cannot repay, then the bank can seek repayment from the guarantor. Usually this type of loan will be personal loan or any kind of facility that provide liquidity to the customer. So it can be an overdraft, it can be a personal loan, whereby a third-party guarantor will come in to secure the repayment of the loan. So consider a scenario where the same borrower takes a loan or murabaha of 100 million, but this time a wealthy individual, maybe his friend or family members, agree to pay the loan if the borrower default. So that is the importance of the guarantee in this risk mitigation. So if the loan or murabaha amount is 1 million, the guarantor will make full repayment of the loan if the borrower default. So if the borrower default, the bank can approach the guarantor to cover the loan, assuming that the guarantor is financially capable. The risk of loss to the bank will be minimized. So benefit of guarantee, the bank can seek repayment from a third party, that is the guarantor, reducing the likelihood of loss from the borrowing default. This can also help the bank reduce the capital requirement, because by having a guarantor against the murabaha facility, the risk weight can further be reduced to 20% or 30%, and therefore freeing capital regulation, which is something that is welcoming to the bank. And finally, we look at the third risk mitigation tool, and that will be the credit default swap, or CDS. So the CDS is a financial contract where the buyer of the swap, which is the bank, pays periodic premium to the seller of the swap or the CDS seller in exchange for a promise that the seller will compensate the buyer if the borrower defaults on their debt. In essence, it acts like an insurance policy on the loan. So this is something that is much newer compared to the collateral and guarantee risk mitigation. So the CDS is, I presume that it is becoming popular since the 2008 US subprime crisis. And so in the sense that the bank can buy a swap, and this swap can be used to protect the bank in case if the borrower couldn't pay the loan. So the swap seller will be the one who will be paying the bank, or who will be compensating the bank for the debt, for the failure to pay the debt obligation. So it is acting like an insurance policy. So in insurance policy, we will normally pay a premium in exchange for the compensation if the event occurs. But the CDS can also be seen as a derivative that can help. It has some benefit, but it can also be used, for speculation. And this is why for the Islamic application, so the use of CDS must qualify the tahawud requirement, meaning that it can only be used if the bank has an existing exposure to protect itself from market volatility. But the way how it is operated is very similar. It's essentially it works like an insurance policy. So for example, assume the bank holds 100 million loan or murabaha and purchases the CDS of 400 million for 1 million coverage to protect itself against possibility of default. So the CDS will cost the bank 5% of the loan value, which is 20,000. 20,000, which is 5% multiplied by 1 million. That will be 20,000 per year. So the loan amount to be covered is 1 million. The CDS premium will be 20,000 times 20,000, which is 5% times the exposure of 1 million. So total CDS protection is 1 million. So if the borrower default, the bank can claim 1 million from the CDS seller to cover its loss. If there's no default, then the bank loses the 20 million premium it paid to the CDS seller, but does not suffer any loan loss, of course, because the CDS will not be used in this case because the borrower did not default. So the benefit of the CDS is that the bank is protected from credit risk associated with the loan or murabaha, and the payment of the premium is the cost of risk mitigation. So this cost can be passed to the borrower, or it can be absorbed by the bank. So that is something that we can look on later. So again, the CDS also helps free or reduce capital regulation or capital requirement, since the CDS have offload the credit risk from the bank to the CDS selling party. So this is a very interesting risk mitigation tool that many banks today have been using to protect themselves from loss, from the loss of default. And the Islamic bank can also be using this technique, given that it is able to prove that it has a current position to be mitigated, and it will not be seen as a gambling or a speculative activity, but an activity for hedging purposes, or to protect the value of the murabaha from default, and that would be acceptable under the tahawud principle. Okay guys, thank you very much for your time. I'll see you again. Assalamualaikum warahmatullahi wabarakatuh.